Joining us right now on the week ahead for the markets is Subadra Rajappa, who is head of U.S. rate strategy at Societe Generale. Also covering the equity side of this is J.J. Kinnigan. He is CEO of IG North America, and welcome to both of you. Subadra, I just want to start with what's happening with the markets. Volatility is definitely the name of the game when you're looking at the bond market, and what Powell said last week at the IMF sounded a lot different than the interpretation we'd had before that. What do you think's going on?
Yeah, no, he's definitely walking back the dovish interpretation of the market after the FOMC meeting last week, or I should say the week before. And what you're starting to see is that there's concern in the Fed that financial conditions are easing too fast, too soon. We saw a 50 basis point rally in 10-year Treasury yields and 30-year yields in a very short amount of time. Mortgage rates came down from above 8% to now below 8%. They just don't want financial conditions easing too soon, because tightening of financial conditions is what's doing the Fed's job for them. As you mentioned, Becky, we're getting CPI this week. Core CPI is still going to be north of 4%. They just don't want the market to start interpreting this as being dovish in any way, because they want to keep their optionality open to hike more if needed.
And, JJ, obviously, all of this impacts equities, too, because equities are kind of getting led around by the nose by what's happening in the bond market. What do you tell retail investors at this point?
Well, I think what was really interesting, Beck, is last week, for the first time in a while, we started to see people have a little bit more conviction and start buying a lot of the individual names. As we've talked before, when people are uncertain, they stay to the indexes and ETFs that are related to indexes. We finally started to see people, the other 493 stocks in the S&P 500 actually had something to do last week.
Is it false, though? Is it a false signal?
I would say it's a signal you have to be a little bit careful of. But what was interesting to me is I look at the stocks our clients bought last week, the top 5, 3 of them were right near 52-week lows, that being UAL, Ford, Newmont Mining. Okay. So I think what is starting to happen is people are, and Eli Lilly being another one. So they're either going for stocks that have done very well, that continue to be quality, or stocks that are getting beaten up, and for the first time, people are willing to take a chance on bottom fishing a little bit.
Well, Subadra, that sounds like something you would do if you think the Fed really has changed its mind. Do you think that they're going after the wrong idea here?
Well, I don't think the Fed's really changed its mind. What the market is thinking about is the Fed done hiking?
Yeah.
And if they are done hiking, then the move should be that we position for perhaps cuts sometime next year. And right now, I think the market's looking at a cut as early as March or even May of next year, which might seem a little bit premature, given that we just don't have much by way of data to justify a policy pivot right now.
I mean, it seems to me that if the Fed actually cut rates as early as March or even May, we would probably be looking at a pretty steep recession that's come in the meantime, because they're pretty adamant that this is not going to happen. So if they do cut rates, it's probably going to have to be a more surprising economic outlook than we're anticipating at this point.
Or our view is that even for the Fed to orchestrate a soft landing, they're going to have to adjust policy a little bit. I mean, we saw this back in the 90s, where they cut rates a few times in the mid-90s and then cut rates again, maybe by 75 basis points during the LTCM crisis. But it was a period where it was a long period of expansion between, I'd say, the 1993, 1994 to 2000. So it's possible that the Fed is looking at a playbook very similar to what we saw back in the 90s.
But it took a crisis, long-term capital management. Are we anticipating a crisis in the financial system that would draw them in like that again?
No, even during LTCM, they only cut rates by 75 basis points. The real cuts happened in 2000 after the tech bubble burst.